again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, the 28th of May, 2020. I've got a great episode for you today. Thank you for tuning in. Again, we encourage you to like and subscribe, and please share with friends, family. We've been dedicated to our clients of the last 8 weeks plus, and providing daily updates, making sense of sort of this unknown sort of new normal that we're venturing in on of the market itself and the economy. But that being said, I'm taking the headlines, looking at market observations, looking at what traders are watching on a daily basis, as well as things that we should be thinking about that we are here at Blanke Schein Wealth Management for our clients as we manage our portfolios and navigate our way through this. So let's get right into it. Our first topic of the day is unemployment claims. The headline, like we've expected, this isn't unexpected. The headline's negative. Absolutely another 2.1 million unemployment claims in the labor market that's just been reported. And it's tragic too, but right now, the data that we have of all of those that have claimed unemployment, about 75% of them are assuming, and employers are looking to rehire them back into the workforce. Only time will tell whether it's a short-term phenomenon or a long-term permanent, that job is no longer available in the workspace, and therefore that person then goes to long-term unemployment. But let's look through the headlines, as I believe the markets are doing. I'm not here to pick on CNBC, but recently I've been using a lot of the CNBC references, utilizing their headlines, but also looking through the data, which I believe that the market is actually looking through the data. If you watch CNBC in the mornings like we do, a lot of their newscasters right now are completely upset, for whatever reason or not, that they don't understand in their financial network why the markets have been up recently. And a lot could be explained, I believe, because the economy is more resilient than we're actually seeing. And the market is looking through not just the next week or 2 weeks, which, who knows what that's going to unfold for us on a short-term basis, but long-term. Historically speaking, the U.S. economy has always come back. It's always been resilient. The question is the timing of which, and what's been priced in is the worst-case scenario early on, meaning it's going to take years to actually come back. Well, what we're finding is, through high frequency data, is there's actually a V shape, meaning we're seeing rail cars, we're seeing people going to the movie theaters, we're seeing a lot of these high frequency data that we get updates on a daily basis. On a daily basis, there's an uptick in airline travel and everything else in the between, from cars to everything you can track. Your phone is tracking your mobile device, and we in California may not be moving, but everyone else is around the United States, and we want them to do it respectfully and safely. That's what our hope and our intent is, and our wish is. But the market's actually seeing that this movement, high frequency data, has actually had a spike or a V-shaped recovery on the retail side, meaning that consumers are now have pent-up demand. They're out of their houses. They're actually returning to shopping malls. One of the most recent reports is some of the malls across America are seeing a net pickup, about 50% capacity of traffic. And they were only anticipating about a 20%, 10 to 20%. So that is not priced in, even in the market, even still to the day, because they're looking for the worst case scenario, at least pricing in the worst case scenario. And therefore, some of the headlines out there are sort of still reporting worst case scenario. So these headlines are perplexing, right? You have negative headlines, but if you look through and actually understand what actually matters, the negative 2.1 million first-time claims, that's a negative headline. That's terrible news, but it's not unexpected. In fact, that's in the ballpark of the estimate that has been anticipated. What hasn't been priced in or expected, or actually the data that actually matters on a go-forward basis, is this number, the continuing claims. That continuing claims, those that are unemployment, 4 million have dropped off of the continuing claims number, which means that there's churn in the marketplace. That means that the unemployment claims have spiked ultimately, and it's the cumulative effect is there's sort of an end in sight. In fact, that's sort of, again, a bell-shaped curve. We're going to see 4 million down on this curve effect, and this is not the medical curve. This is the unemployment claim curve. And now we've actually seen sort of the peak, hopefully. I mean, hopefully that's the peak that we've seen recently. But that's what the market is looking at right now, and that's what the market sees, because that's the number that matters. on a go forward basis. So we want this number to continue to go down. This may go up, but the rate of increase may decrease, if that makes sense. So it's not going to go up as, we might see less than 2 million on a weekly claim. And we want to see this number. This is the only number on a go forward basis that actually matters from this point forward, which means it translates into government intervention and government assistance has been the safety net in the short term, but ultimately the economic engine of America is reopening, and those businesses need those employees to come back because retail demand is there. My next topic of the day, U.S. GDP. We also got a negative headline as it relates to our U.S. GDP that in the first quarter of 2020 had contracted by 5%. And if you look at it, all 2029 GDP was up. Okay, I keep talking about the gross domestic product, and it's important to keep that because it's basically, in simple terms, it's a way of measuring the economy, whether you're growing or contracting. And the U.S. economy is 19 trillion, the past trailing 12, if you will, of the U.S. economy prior to the pandemic. And so now we've sort of hit pause, right? A government mandated shutdown, and you're going to take a chunk out of the U.S. economy. So the goods and services of retail and everything else that happens in the U.S. economy is literally put on pause, okay? If not all, but most parts of the economy in the United States. So what we're going to see is the first quarter we just had reported as negative contraction of the U.S. GDP. The second quarter, right? So the next 3 months, we're going to see what it actually looks like. And forecasts have had, this could be the worst contraction in history for the GDP for one quarter. Time will tell. I will be here with you, and we're going to see what it actually becomes, and could be negative 20, 30, even 40% from some estimates, meaning that the U.S. economy literally put on hold and put on pause, and therefore the consumption and everything else that happens to make an economy go and grow was completely flatlined. And that's not unexpected. I mean, that's something to be expected, and wouldn't be a shock to see a super big number, as the headlines will certainly report. But what's equally interesting and intriguing that the markets are now looking at on a go-forward basis is they're not looking at the second quarter. They're looking through, as they keep pointing to, and they're going as far as 2021 because they know the economy will recover at some form or fashion. We don't know the timing of which, but we know that America will bounce back as it always has, and corporate America will make it happen. But in the meantime, the third quarter GDP is the one that's going to actually matter, okay? And the only way I can describe this, because I'm not going to give you a guesstimate here, but I think the best way to think about it is when you take an elastic band and the further and stronger you stretch and stretch and stretch on an elastic band, the higher the force and the velocity of the snapback and the rebound potentially could be. We were already a very strong economy at all-time highs in many sort of sectors of the U.S. economy in February leading into this when we shut everything down. And so that stretch could theoretically bounce back. Now, we don't know if it's a V shape or whatever shape it is. I still happen to think it's going to be a Nike swoosh, but the economic data could be higher than we ever seen for the third quarter. I think we potentially could see the highest print on a third quarter GDP that we've ever seen in the U.S. economy in history. So time will tell. But it's interesting to see the GDP matters, and that's we're going to keep an eye on it as a go-forward basis. But we know, and let's not be spooked by this, unexpected, the second quarter GDP, it could be historically one of the worst that we've seen, maybe as recent as 1947 or even before, back to the Depression. But I think that the subsequent quarter, the third quarter, we could see some pretty huge surprise to the upside. Much like we would be to the downside in the second quarter. So time will tell, but let's stay tuned and keep our eye on the GDP. So to sort of summary of today's topics real quick of, unemployment, and we believe that we're seeing some constructive sort of bounce back effect, and people are coming back as businesses need their employees back to help retailers, because the retail demand on a V-shaped recovery, we're actually seeing it right now. Now, Robert, how do you know, and how do you think that there's going to be a positive third quarter GDP? And how is that even possible? Well, the U.S. economy, 2/3 of it is consumer based, right? So our economic engine of the U.S. GDP is based upon a function of the consumer actually spending money, right? We're a consumption economy. And so this consumption economy is based upon another factor that we're watching, which is the M2 money supply, which is, in historically speaking terms, has never been this high, ever. So past 13 weeks up 82%, year over year up 23%. And the short take home point of that is it's consumers and small businesses and monies that they have and measured in the banks. So we know that the money is in the hands of the consumer and the small business owners, and we know it's sitting in the banks right now, and it's working its way in the system. And how do we know this? Because we have 4 million actually coming off of continuing claims, and we also will see potentially the GDP grow in the third quarter once we get through a negative second quarter GDP number, and we're going to see this money work its way in the economy. At least that's the design of and the intention of both fiscal and monetary policy when they first set forth. So we know the money is in the hands of the consumer and small business owner. We know that the retail demand is back out, and we know that the employees are coming back to work. So a lot of this is functioning right now. I think that's what the market is seeing, and that's what matters. So don't be spooked by headlines out there. Actually look through the headlines like the market does and pay attention to what matters. Thanks for watching.